If you're a high-income earner, you've probably run into this problem at some point. You make too much money to contribute directly to a Roth IRA, which is frustrating because Roth IRAs are one of the most powerful tools for building tax-free wealth. But here's the good news. There's a completely legal workaround that allows you to still take advantage of those benefits. It's called the Backdoor Roth IRA. And in this video, I'm going to break down exactly what it is, how it works, and how you can set it up step by step. Welcome to the Ways of the Wealthy, where we help demystify the habits of the ultra-rich. Let's start with the basics. A backdoor Roth IRA isn't a special type of account. It's simply a strategy. Normally, the IRS sets income limits that prevent high earners from contributing directly to a Roth IRA. But those limits only apply to contributions, not conversions. So instead of contributing directly, you first put money into a traditional IRA and then convert it into a Roth IRA. That's the entire idea behind the back door. Now, the reason people go through this extra step is because of how powerful a Roth IRA is. You contribute money that's already been taxed, but from that point forward, everything grows tax-free. And when you withdraw the money in retirement, both your contributions and your investment gains can be taken out completely tax-free, as long as you meet the requirements. On top of that, Roth IRAs don't have required minimum distributions, which gives you more flexibility later in life. The issue is that many high earners don't qualify to contribute directly. For example, in 2026, if you're single and earning above roughly $168,000, or married filing jointly and earning above about $252,000, you're no longer eligible to contribute directly to a Roth IRA. But again, there are no income limits when it comes to conversions, which is what makes this strategy possible. So how do you actually set it up? The process is fairly straightforward, but it's important to follow each step carefully. First, you open a traditional IRA if you don't already have one. Then, you make a non-deductible contribution using after-tax money. After that, you wait for the funds to settle, which usually takes a couple of days. Once the funds are available, you convert that amount into a Roth IRA. And finally, when you file your taxes, you'll need to submit IRS Form 8606 to properly report the transaction and avoid being taxed twice. Now, there's one key rule you need to understand before doing this, and it's called the pro-rata rule. If you already have money in other traditional IRAs, especially pre-tax money, the IRS treats all of your IRA balances as one combined pool. So when you convert money, a portion of that conversion may be considered taxable, even if your new contribution was after tax. This can significantly reduce the tax efficiency of the strategy, so it's something you need to plan for in advance. In terms of taxes, most people won't owe anything on the conversion itself, since the contribution was already taxed. However, if your money increases in value between the time you contribute and the time you convert, that gain will be taxable. That's why many investors choose to complete the conversion relatively quickly. There's also a more advanced version of this strategy known as the Mega Backdoor Roth. This involves using a 401k plan instead of an IRA. If your plan allows after-tax contributions and in-plan conversions, you can contribute significantly more money, sometimes up to the total annual 401k limit, which can be as high as $72,000. However, not all plans offer this feature, so it's something you'd need to check with your employer. So when does this not make sense? If you're eligible to contribute directly to a Roth IRA, then you don't need to use this strategy at all. It may also not be ideal if you have large pre-tax IRA balances due to the pro-rata rule. And if you plan to withdraw the money within a short time frame, you likely won't benefit enough from the long-term tax advantages. At the end of the day, the backdoor Roth IRA might sound complicated at first, but once you understand how it works, it's actually a very logical process. And for high earners looking to build tax-free wealth over time, it can be an incredibly useful strategy. If you found this helpful, Make sure to subscribe for more content like this, and I'll see you in the next video.